Hi everybody, it's John Jay. Today's January 30th, and I'm just going to make this recording. It's going to be in two parts, and I know it's a still video. Sorry about that. It's a still image, just because my camera's not working where I'm located right now. Sorry about that. Don't have my regular gear. But anyways, I want to talk about two things. So the first one, the first subject is going to be on the cryptocurrency and the taxes. Okay. Now the reason why I use that, I'm using this as an example. Okay, cryptocurrency is just property, just like precious metals, just like real estate, just like stock, and even income. Okay, cash flow. So I want to use cryptocurrency as the example and talk about why cryptocurrency is not taxable. The reason being is that it's not the thing you pay the tax in. It's very simple, okay? No law has changed since the cryptos came into being, which was January 3rd, 2009, if I remember correctly. Nothing's changed except in 2014, the IRS defined cryptos as property. So that just brought the definition into the category of precious metals, which brought in, well, 100 years of case law. Very, very helpful to us. Okay, it was very favorable that the IRS did that. Um, and so it's pretty simple regarding taxes because if you put cash dollars into property, excuse me, and the property changes value, you don't necessarily have a tax liability. Okay, there's no reporting duty. There's no gain. There's not a gain until there's a disposition of property, disposition of assets, as they call it. And you can find this in IRS circulars, and I've mentioned various ones over the years. You guys can look it up yourself. Look at the definition of gain, and the disposition of property is part of the definition. You'll see that until there's a disposition, there's not a gain. And so for the disposition is not trading coins for other coins. The disposition of gold is not trading gold for silver, okay? Especially where the beneficial interests remain the same. So if I dispose of something like, look, go back to the example of cryptos. If I have a coin where I'm the owner and I'm the only one that cares about it, for example, and then I acquire someone else's coin, he has a different interest, okay? And I traded my Bitcoin, for example, for his coin, Litecoin, for example. Now, there was no disposition of property by either party. I just traded something of value for something else of value, and it was a single point transaction. There was no, maybe I go back there, right? But it doesn't matter. It doesn't matter if I reverse the transaction. It doesn't matter. What matters is that there's a disposition of the property. So the property, let's say the disposition of it is taxable, but we know that the property itself is not subject to a tax, meaning that I'm not required to dispose of the property to pay a tax. We all understand this principle. So if you want to account for a value change in your property, let's say you traded gold and crypto and back and forth, and the dollars you started out with now are worth more dollars, you can certainly report it that way. This is known as accrual-based accounting. There's nothing wrong with that. It's just not necessary. So what I'm talking about is understanding that you have a choice that you can choose cash basis accounting. That means you're going to stick with a strict definition of disposition of property. All right. That means I disposed of it, so I no longer have an interest in the property, and I traded it for dollars. Then it becomes reportable or taxable or both. Now, in the situation where we're dealing with the crypto exchanges are the owner of the coin. So you're not actually at the point of owning the coin and then moving it around. So you're not even changing ownership. So when you move the coins onto the exchange, the ownership remains the same. So that's even a better example of where, and the reason why there is not a tax liability, because even though you're logging into the account and you're moving coins around, you're actually not doing that. What you're doing is you're moving tokens around, let's call it, okay, to show what you have in a, let's call it a superficial ledger on top of the actual Bitcoin blockchain, all right, or the crypto blockchain. You're using the exchange's software to show a change in interest. So that way, when you sell, okay, when you sell back to the exchange, what will happen is the exchange is just going to simply give you dollars, okay? At that point, there may be a disposition and there may be a tax liability, okay? It's not when you're going from coin to coin, at least for the reason that you're not even the owner, okay? The exchange is. Literally, the exchange is the owner because it has the exclusive access to the private keys. That is the reason why the exchange is the owner. Now, if we take this a step further to another level, let's say we get into a transaction where it is taxable. Well, that's because we have a property right that we're exercising in our own name. And because most of us filed 1040s over the years, that creates the expectation to file another 1040 is the best way for me to explain it. There's no duty to file the 1040. It's just that when you do file it, the government regards it as having been required to be filed. That's all. It's weird. It's a weird situation, but that's how the tax system works. Okay, it doesn't impose a duty. What happens is it tricks you into doing something, then you have a duty because you did it, okay, wherein you didn't have to do it in the first place. But without getting into all that, let's just say that the transaction is taxable, okay? Let's say you actually did sell property, coins, precious metals, real estate, you sold that for dollars. Doesn't mean you have to do it in your name. So the way that works is I can retain the beneficial interest by conveying the property. So one example of that would be is if I had a crypto account at a third party exchange and I open another crypto account at that same exchange, that was a limited liability company. And then I moved from my wallet, my personal wallet, to the LLC wallet. Then I would change the titling, the manner in which the property is titled. Okay, even though I retain the beneficial interest, and really I'm retaining the ownership. Okay, all I'm really doing is retitling the property so that when I dispose of it for dollars, where it would be taxable, because it's being disposed of in a, let's call it a non-taxable party, okay, the LLC is not subject to a tax until it files a tax return, and it's not required to file a tax return. So if the disposition of the coins or real estate or whatever is in the name of the LLC, yeah, the LLC might get a 1099. The LLC might have an EIN. All that stuff is not really relevant. That doesn't create a tax liability. But the money goes to the LLC, and yeah, it's a taxable amount of money, but because of the nature of the LLC, because it's not a taxpayer, for the reason that it didn't file a return, and it doesn't need to file a return, the tax liability is deferred. There's no problem with that. It's just the way things work. Okay. Now I can give you plenty of examples of that, but you can then move that money around in certain ways. Now the limit is if I were to use an LLC to dispose of property that would generate a tax liability, but I do it in the name of the LLC, right? Uh, then I'm not going to have an issue with the IRS. The 1099 will get issued to the LLC with its tax number. Even though I own 100% of the LLC, I'm not going to be dealing with the IRS as far as having underreported, for example. But I can use that money however I want. I decide how that LLC is going to move that money around. It can spend money, it can buy things. And large ticket items are very easy to avoid the tax liability, ironically. If I'm going to spend the money from the LLC on small items, it's more difficult to say that it's the LLC money. Okay, so for example, if I use the LLC money to pay off my credit card bill, my personal credit card bill, well then that's personal use of the money, and therefore it's part of my taxable gross income. It should be reported on my 1040 as other income. So the LLC is the tool, and this is what I want to get to in the conversation. The LLC is the tool that you can use to create a party, at least for one or two purposes. One is to retitle the property so that when it's disposed of, you're not going to have the tax liability and you can legally avoid it, okay? Even if you're 100% owner of the LLC. If you want to remove the property rights from your estate, this is how you clear and separate property from personal claims made against yourself. That is, if someone sues you or anyone wants to make a claim against you individually, he's not able to use that claim to reach into your interest in the limited liability company on the premise that, or if the situation is that you're not the only owner. If you're the only owner, the 100% member owner of the LLC, then a person who makes a claim against you individually could ultimately make a claim against the LLC, okay, and your property because you have 100% interest. If you add another person, and it doesn't matter what his interest is, but if you add another person by simply amending the articles, and this person cannot be, it cannot be a spouse, okay? And yeah, sure, you can add entities and all that. I don't want to talk about that. I'm just saying, if you have two people on an LLC that are not married, you have something called charging order protection that prevents claims made against either of the parties separately from being attached to that person's interest in the company. The exception being that if the company disperses funds to that one member, then that's fair game to be levied, okay? Provided that the levy is active at the time that happens. So there's all these conditions on there, but what you're doing with the LLC is you're removing property rights from a situation where a liability could attach to the property rights. You're removing it to a safe zone, okay? It's different if I own something than if myself and my brother own something. It's completely different because my brother's individual debt liability doesn't attach to the thing that he and I own because he and I are considered joint and several owners, and no one can step into that and take that property unless a claim can be made against both of us at the same time. So we would have to both have a debt obligation, for example, or both have to sign a joint tax return, or both have to sign a commercial lease agreement, right? If we have a joint liability, okay, then the LLC is not going to protect us. So how would I change that? Well, I would simply add another member by amending the articles, and I could have three people, okay? And again, the same rules apply. It goes on from there. So that's the idea. So I just wanted to review this. I know many of you already understand this. I want to review this, and then there's another part I'm gonna include here, and we'll get to that in just a second.